Most Australians think you need $5 million to never work again. The finance industry loves that number. It keeps you scared. It keeps you working. But what if I told you the real number is much, much lower than that? Today we're going to break down exactly how much you need invested in ASX shares to live off dividends forever using real 2026 numbers, not guesswork. And look, this isn't about getting rich overnight. This is about understanding a system that thousands of ordinary Australians are already using to quietly walk away from their jobs for good. First, let's talk about why Australia is actually one of the best countries in the world for dividend investing. Because this part? Most people completely miss it. The ASX 200, Australia's top 200 companies, currently has an average dividend yield of 4.57%. That's more than 3 times higher than the US S&P500, which sits at just 1.24%. That difference is enormous. It means you need a portfolio 3 times smaller in Australia to generate the same income as an American investor. That's a massive advantage most Australians take for granted. But here's where it gets really interesting, and a little confusing at first. Australia has something called franking credits, and once you understand them, everything changes. When an Australian company earns a profit, it pays 30% tax to the government before sending you your dividend. So on $100 of profit, you get $70 in cash. But here's the thing that $30 the company already paid. The ATO gives it back to you as a franking credit. You're not taxed twice. The government says that tax has already been paid on your behalf. So, when you see a stock paying 4% cash yield with full franking, the real yield after franking credits is actually 5.71%. That's a 43% boost on your income for free. And for retirees in pension phase through super, the government literally sends you a cash refund for franking credits you can't even use. It's basically free money sitting on the table. Alright, so let's get to the number everyone came here for. How much do you actually need invested to live off dividends in Australia? Let's use $50,000 a year as our target. That's roughly the average Australian income, and honestly enough to live comfortably in most parts of Australia if your mortgage is paid off. At a 4% cash yield, which is conservative for the ASX, you'd need $1,250,000 invested. That sounds like a lot. But wait! Factor in franking credits, and that grossed up yield jumps to 5.71%. Now the maths looks very different. To generate $50,000 a year with franking credits included, you only need $875,000. That's $375,000 less than the simple calculation. Franking credits just saved you over $375,000 in required savings. Let's look at different income targets so you can find yours. For $30,000 a year, a very lean retirement with super topped up, you need around $525,000. For $50,000 a year, comfortable for a single person with no mortgage, $875,000. For $80,000 a year, 2 people living well, $1,400,000. These numbers are real and achievable. They're not the $5 million the finance industry wants you to believe. Now, which ASX stocks and ETFs are actually paying these yields? Because putting everything in one stock is how people lose everything. The backbone of any Australian dividend portfolio is the Big Four banks: Commonwealth Bank, ANZ, NAB, and Westpac. Between them, they consistently deliver grossed-up yields of 5.5% to 6% in 2026. CBA trades at a premium, so the yield looks lower on paper, around 3.9% grossed up. But ANZ, NAB, and Westpac are sitting at closer to 6%, fully franked. That's serious income. Then you've got the miners. BHP is forecasting a 5% yield with full franking, grossing up to around 7.5%. That's exceptional. Fortescue goes higher but moves more with iron ore prices, so it carries more volatility. And for people who don't want to pick individual stocks, which is totally fair, there are ETFs that do all this for you automatically. VAS from Vanguard tracks the ASX 300 and currently pays a cash yield of around 3.5 to 4.5%, most of it franked. Management fee is just 0.07%. That's almost nothing. A 200 from Better Shares is similar tracks the ASX 200 yield around 4%, fee of just 0.04%. Both are solid, simple, set-and-forget options for building a dividend portfolio without picking individual stocks. But here's the part most videos don't tell you. There is a catch. Actually, a few of them. First, tax. Before you access super in pension phase at 60, dividends are taxed at your marginal rate. If you're earning $50,000 in dividends and still working, you might be paying 32.5 cents in the dollar on that income. The good news? The tax-free threshold in Australia is $18,200. If dividends are your only income source and you keep things structured properly, a huge chunk of that income comes in completely tax-free. In fact, if you're receiving $30,000 in fully franked dividends and that's your only income, you could end up paying zero net tax. The franking credits more than cover your liability, and you get the rest back as a cash refund. Second, catch dividends can be cut. During COVID in 2020, a quarter of Australian companies reduced or suspended their dividends entirely. It happened fast, and it hurt income investors hard. The protection against that is diversification. At least 15 to 20 different companies, or an ETF, holding hundreds of them. When one cuts its dividend, the others hold the portfolio up. Third catch, and this one nobody talks about, getting to $875,000 takes time. A lot of time, for most people. Let's be honest about that. If you're investing $2,000 a month into ASX dividend shares, reinvesting all dividends, assuming 7% total annual return, you get there in roughly 17 years. At $3,000 a month, you're looking at 13 years. 13 to 17 years sounds long. But think about it, most Australians work for 40 years before retiring. You're cutting that timeline in half, or better. And here's where it gets clever for Australians specifically. Because super completely changes the equation. Inside super, once you hit pension phase at 60, you pay zero tax on investment income. Zero. That means your 5.71% grossed-up yield is entirely yours to keep. In an SMSF in full pension phase, you also receive the full franking credit refund as cash. A $100,000 portfolio of fully franked ASX stocks yielding 5% generates $5,000 cash plus $2,143 in franking credit refunds. That's a 43% uplift on your cash income simply because of how super is structured. So the smartest strategy for most Australians is a dual track. Build a portfolio inside super, taking advantage of the 15% concessional tax rate during accumulation, and build one outside super for the years before you turn 60. Inside super catches up quickly because every dollar saved in tax goes back into your portfolio. Outside super gives you flexibility and income before age 60 if you want to retire early. Let's recap the real numbers. ASX dividend yield, right now, 4.57% cash. Grossed up with franking credits, 5.71%. Portfolio needed for $50,000 a year. $875,000, not $5 million. Portfolio needed for $30,000 a year, $525,000. Time to get there. Investing $2,000 a month, 13 to 17 years. These are the numbers the finance industry doesn't advertise. Because if every Australian knew them, they'd stop buying expensive managed funds and just buy VAS or A200 and wait. The truth about living off dividends in Australia is that it's not a fantasy reserved for the wealthy. It's a maths problem. And the maths, thanks to franking credits and the ASX's naturally high yields, works in your favour in a way almost no other country can offer. The only question is, when do you start? Because every year you wait, that's another year your dividends aren't compounding, your franking credits aren't stacking, and your financial freedom isn't getting closer. Now, one last thing before you go. None of this is financial advice. I'm not a licensed financial advisor, and every situation is different. Always speak to a registered financial advisor before making any investment decisions. If this video helped you understand the real numbers behind Australian dividend investing, hit subscribe. Next week, we're breaking down exactly why thousands of Australians are quietly retiring in Asia and what it actually costs. See you then.